Hi everybody, I wanted to continue this week. We're actually doing Introduction to Risk and Return. And before even getting into the idea of what is going on with this week, what is going on with the chapter, this is basically we're talking about in the equity market primarily. But I think that in the asset management world, of course, everybody kind of knows about returns metrics, but what is risk really? And this week we're going to talk about standard deviation as basically the idea of risk, a measure of risk. And I think that um, one way I look at it is what is the standard deviation of, for example, the market? And we can look it up for a second and just say, hey, what is the standard deviation of S&P 500? And basically, in the last 3 years, you could see that it's 10.86. So what does that mean? That the standard deviation of the S&P 500 the last 3 years is about 11. That means that the return basically varies by 11% from the mean on average. So in other words, say the S&P, and I'm just making a number, but say the average return was like 3% or something like a 5%. It could, on average, it varies 10, I mean, almost 11 from that. So it could have been 16 one year, it could have been negative 6 one year, and 5 one year. And that standard deviation basically works, kind of. So imagine if I told you the standard deviation of the S&P was like 30%. That means that, yeah, maybe the average return for the last 3 years has been like, say, 5%, but it could have been 1 year negative 25, and 1 year plus 35, and 1 year plus 7. So standard deviation tells you, and again, this is historically speaking, how much is the return jumping around away from the mean on an average, basically, telling you, which can tell you, hey, next year, I don't, how much volatility can I expect? And basically, now that we're talking volatility, this is what the measure is. And if you look, like, what's the standard deviation of the equity market of Greece? What's the standard deviation of Greek government bonds? And then you could start seeing, this is what I want you guys to take a look at. Go online and look a couple of these things up, rather than, I think we get so deep into the math in this chapter. It's more important to just, how do you use this number? Yeah, we will calculate it using the math, but how do you use it? How if I show you a standard deviation of something, how risky is that asset? And the next thing is, how you know, do you want that? Maybe you want a standard deviation of 30%. Maybe you want to invest in the Greek equity market. With a high standard deviation, you could get a huge return as well, because you're saying, oh, standard deviation of 30, that means I could easily be plus, 40% next year. So that's basically telling you, wow, there could be a lot of potential here. So that's the idea in a nutshell of what this chapter is all about. In a nutshell, of kind of like, what are we really trying to get to? What are we really trying to understand in terms of this idea? And in terms of market returns and things like that. This is kind of market risk premium. And basically, this is showing us, let's see where we are here. This is basically showing us what is the return that the market is providing in general. How much of a return do people want in order to invest in the market? And this is rates of return in the US, I believe. And you could see how volatile the returns have been, even though the average in the US in the market has been around 7%. Look how, over this long period of time, of about 100 years, but look how volatile that 7% has been. And this is like just showing you the variability of returns. And the histogram is also showing us some more statistics, like, how many times have we fallen into this category of 20 to 30 returns, or how many times have we fallen into a negative 10 to 20 returns. And it's interesting, people oftentimes say, oh yeah, the used market, easy way, to make money long term, but short term, everybody says no, it's not the best way to make money, because here are the limitations, that short term you could be falling into the negative side of the standard deviation. And kind of jumping out of all this for a moment, what is really the US market driven by? Sure, this is like kind of like we're talking about statistics on a data set, and we're getting really particular about how to do these math equations and the statistics. But don't forget, what is really driving, this long-term steady return is basically the steady rise in the equity values of corporations in the US, which means the overall growth prospect of the US economy has been growing steadily at a certain rate. And this is really what we have seen the trend of. It's just this massive growth. If a dollar became 18.99 for over the last 100 years in the US equity market. So what does that mean? It basically means that is just the value of equities in the US, and this is a function of growth. That's how much the economy has grown in the US in terms of its size and value. And that makes sense to me. Think about GDP at the turn of basically the 19th century and now 120 years. Think about the GDP size. Yeah, sure, I believe that that's a factor of 2000, and that is really the indication ultimately of why this has been such a substantial growth.